Welcome to the Personal Pension Radio Podcast, where you get unconventional insights into wealth building and retirement that actually work. Break away from the herd and discover data-driven strategies and learn from a wealth of experience so that you can take your retirement to the next level. Now, here's your host, the income engineer, Kraig Strom.
All right, fantastic. That's going to be my word to start every podcast with. I think is fantastic. I'm joined in studio with Marc Miller.
Hey, good to be here.
Awesome. We are on episode 15 of the Personal Pension Radio Podcast, broadcasting here from the 95th floor of the Personal Pension Formulation Tower in beautiful South Corona. So how are things going with you, Mr. Marc?
Well, I will use your word of fantastic. Things are going great. Beautiful day here in Southern California.
Yes, and how is the grandchild doing?
Fantastic. That's why I wasn't on the last podcast. I was visiting my new granddaughter, who is just doing fantastic.
Good. And I have to say, I think that Personal Pension Radio, the podcast itself, has been extremely well received, something you noticed on the statistics earlier this morning.
Yeah, we're approaching 2,000 downloads, which is great. And it's
basically in 2 months, right?
That's right. Well, actually, really in a month.
Right.
We really went heavy last month, and now we're approaching 2,000 downloads nationwide. And so
we want to thank everybody out there in the audience, everybody out there that is listening, that has been sharing this with friends and family and downloading the content. We really appreciate your support, and we are going to do our best to continue to bring you great information, great content.
Agreed.
So Personal Pension Radio, what it's all about. When you look at the financial world today, the message is constantly focused on save more, save more. I actually talked to somebody recently on a business trip that I returned from this week, and they had gone in to talk to a financial advisor to get their retirement income kind of figured out. They're kind of close to retirement. They really should have been talking about it sooner, but they didn't think about it sooner. So they went in and they asked about retirement income planning. When they found out what their retirement income number was from their Wall Street financial advisor, they were quite shocked. They weren't happy.
Shocked or panicked?
Well, I have to say it sounded like both. They were pretty panicked, I guess you'd say. And I asked them, what was the solution? What was the suggestion from the financial advisor? And this was from a big Wall Street brokerage firm that we all know about. What do you think the suggestion was?
Well, I would likely say either save more or work longer.
Yeah, it was basically both. That was the only answer given was, I'm sorry, that's the number, and if you want the number to be bigger, you just need to save more money. That was it. So in order to save more money...
That's depressing.
That is extremely depressing, but I have to say, then they met me. Okay, and...
That's depressing too. No.
And then they met me, and we had the conversation about the two financial powers. And if you don't recall the two financial powers conversation, if you haven't heard that here on the podcast, just go right back to personalpensionradio.com. You can actually see it right there in our list of podcasts. And we went through this idea of bringing back together the retirement financial powers and how if we use those correctly for their retirement planning.
Well, what's powerful about the two financial powers is that either power by themselves are ineffective. And so if you use just one of the powers, it's an effective growth tool, but it's not an effective income tool. But together, those two powers have enormous results.
That is key. What Marc just said is so key. You can have an effective growth strategy that does not get you to an effective income strategy.
That's correct.
So here at Personal Pension Radio, what we're all about is helping our clients, helping our listeners build the proper balance between accumulation assets and distribution planning. That's the key. You've got to have the accumulation side of the mountain, and you've got to have the distribution side.
That's correct, because everyone's goal is income in retirement.
Right. Well,
hello.
Ask anybody. The question that we've asked before is, in retirement, which is more important? The size of your 401k statement or the paycheck that you get in your bank account every month?
It's absolutely the paycheck. It's when I open the mailbox, I want to make sure that I see a paycheck for that month for me to be able to live during retirement and enjoy my retirement.
Absolutely. Yeah, that's the key.
If I want to work at the golf course after I retire, I want that to be my decision because I want to get free golf, not because I need it to eat.
Right. If it's the whole adage of welcome to Walmart, and you become a people greeter at Walmart.
That's right.
Well, I don't know if you heard this, but Walmart's actually cutting back on the number of people greeters that they have nationwide based on minimum wage increases.
You mean the smiley face is going away at Walmart?
The smiley face is going away. Apparently, they couldn't pay the smiley face's wage anymore, so apparently they're starting to cut back on some of those people greeter folks. So let's make sure that we actually work together to build the right balance, have maximum income in retirement. And the fun part about it is those folks that I mentioned earlier, they don't have to sacrifice their lifestyle today to achieve that higher income. And it's just a shame that the financial advisory community, almost as a whole, they're not talking about it.
Well, it's not asking you for more money. It's an allocation strategy. It's economically based, and it's taking a look at what you're currently allocating and allocating it correctly with the end in mind so you can maximize your income potential.
No, that's totally right. Well, just so we don't forget, if you head on over to personalpensionformulation.com, you can actually download a copy of a free report that Marc and I have written that it's the retirement income crisis in America is a substantial issue that everybody needs to be aware of. You've got to deal with it. You've got to know about it sooner than later, because if you wait too long, it does make things more difficult. So get on over there and download the free report. But
you don't have to be part of the crisis, by the way.
No,
you don't have to relegate yourself to be part of that outcome. You can make a change and have an opportunity to have that not be part of your end result.
Right. You can choose not to participate in that particular bad thing.
That's right. I choose not to do that.
I do not want to participate. Well, listen, the section that we usually start with is the section we call Watch Your Step. This is an area that we want to make sure that you're paying attention to the landmines or the surprises, the potholes, whatever might be around you, that you can just be aware of the news that might not be in the mainstream media, but that you just need to know about. And something actually caught my eye in an interview that I was listening to recently, and it was actually a discussion about some comments that Robert Shiller had made. Now, if you don't know who Robert Shiller is, he is an economist at Yale University. He's also an author of a number of different books. One of his most famous books was The Irrational Exuberance. Okay, and most importantly,
he won the Nobel Prize, didn't he?
Yeah, that was a little thing that he did last year, I believe it was.
That's a little trophy.
He's a Nobel laureate for economics. He's also famous for a number of very standard, worldwide used economic indexes, the Case-Shiller Index, variety of things. So
he's a lot smarter than I am.
He's way smarter than I am as well. Marc and I combined are still not nearly as smart as this guy. Let's put it that way. But the part that actually caught my eye about this was it was a conversation, some comments actually that Robert Shiller, a brilliant economist who has no skin in the Wall Street game.
That's right.
Right? He's not a Wall Street person. He's not an insider on Wall Street. He's a professor of economics.
He's an intellectual.
He's an intellectual, exactly. So his comments were in relation to retirement in America and retirement assets. That he had actually said that we need to come out strongly against over-reliance on the stock market. Wow.
That's a pretty bold statement.
That is a very bold statement, that we've got to come out against over-reliance on the stock market. And yet, what do we hear from clients all the time, Marc? The stock market is the answer.
That's right.
You just have to save more money in your mutual fund.
They're parroting what they've already heard, that the media is saying, and what they're hearing from their current advisors is that the stock market is their answer.
Well, even financial entertainers.
Absolutely.
Financial entertainers constantly saying that the 401k, the IRA, the stock market is the answer.
By the way, the stock market is a portion of the answer.
Absolutely. It's part of the journey. No, that's a great reminder.
I mean, when we are climbing, we do need to wear shoes.
That's right. We've got to have some security, some guarantee, something. So what Robert Shiller goes on to say is that a substantial portion of retirement assets should be allocated into, okay, you ready for this? Because this first one kind of makes sense. Everybody's maybe heard this before. Inflation-indexed government bonds. Okay, so a government bond right now, the 10-year Treasury is paying out at about 2%. That doesn't sound great, but it's still way higher than the rest of the world.
And somewhat stable.
It's very, it's pretty stable. So a substantial portion of retirement assets be put into inflation-indexed government bonds. And then, are you ready for it? Inflation-indexed retirement annuities.
Now, didn't you just do a podcast on annuities?
Just mentioned annuities in our last podcast. You can go back and take a listen to that. Absolutely. You got to listen to that one just actually 2 podcasts ago on episode 13, I believe, with Marc Anderson. That Robert Shiller, Nobel laureate, says a substantial portion of retirement assets should be placed into retirement annuities.
Well, and he's suggesting that's how you derive your income. Is that not correct?
Right, because we're talking about retirement assets are income assets.
And what kind of income is derived from that? Is it variable? Is it guaranteed?
Good point. The type of income that comes out of these types of annuities is guaranteed income.
Again, right in line with what the American public over the last several months and years is starting to scream for, guaranteed income. We've talked about it in other podcasts. Willing to give up some of my income to get that pension.
70 to 80% of anybody, workers surveyed, say that they would give up part of their pay today to have a guaranteed personal pension.
Amen.
Yeah, absolutely. Shiller actually goes on to throw in an additional and urges retirees to take retirement income in this form. To get your retirement income in the form of guaranteed allocations. Now, Shiller is not out publicly saying that people should flee Wall Street, that they should leave the stock market, and
nor are we.
No, good point, Mark. You had actually a comment about that earlier when we were preparing for the podcast today, as it relates to our feelings about the 401k and the stock market in general.
Absolutely necessary. You're going to need these tools as you are climbing the mountain. Again, this is looking at and allocating our resources in a way, obviously into the markets, but also allocating to distribution assets for the future, actuarial assets. And those two powers together will give us the opportunity to maximize our income when we retire.
Right. No, right on track there. So when you look at someone like Robert Shiller, who, again, he's an academic, he's an economist, he's a Nobel Prize winning laureate. I mean, we've got all that. But he says a component needs to include, or in retirement income component needs to be annuities. And then in the same, when you're out there looking online, if you type in the word annuities or retirement annuities into a Google search, so many times a gentleman named Ken Fisher he's the founder of Fisher Investments. He's one of the wealthiest men in America. Comes up with an advertisement somewhere on your screen that says, "I hate annuities." And get my free report and learn why he hates annuities. That's a pretty bold statement. It sounds like a huge bias, doesn't it?
Yeah, well, it is a bias. And you can't have that kind of bias when you are in this game, if you will. You can't have a bias toward a certain asset class if the end result is maximum income, then you have to be open to all of the possibilities that are available to create that income.
Right, because we've said it before, we'll say it every time that the question is asked, that a particular financial product, whether it's a mutual fund, whether it's life insurance, whether it's real estate or annuities, whatever it is. A business asset. Not one of those individual financial products or assets is the answer unto itself.
That's right. Well, we just talked about those two financial powers. Again, we're coming back to it, but it's really important to understand these powers used by themselves are not effective. But together, when you put these things all together, strategically put them together and align them in a way that will maximize your income when you retire, that's the key.
No, it's right on track. Okay, good. That's very good. So really interesting. We're going to link all of this up in the show notes. If you want to ask about this or if you have any questions, always you can contact us right through the websites. But now, this expert advice to avoid. We do cover this when this pops up, and I have to say I about jumped out of my seat on a flight to Virginia this last week. Did you have a
parachute or just...
Oh my gosh, just jumping out of my seat. I didn't want to leave the plane necessarily, but I don't believe in jumping out of a perfectly good airplane. I don't see any point in that. So those of you in the audience who are skydivers and bungee jumpers, more power to you.
That's right.
Okay. So, but I was actually listening to Dave Ramsey's podcast. So you've heard us mention Dave Ramsey on our podcast a number of times because Dave is a very prominent voice in the world out there, very prominent voice, and he has a huge audience, a huge following that come to him for financial advice.
Yes.
Okay. Now, Dave is a financial entertainer. He's not an actual licensed financial planner. He's an entertainer. So I'm listening to his podcast, and I'm going to share something with you that he said that I absolutely agree with. I completely agree with something that he said on this same exact podcast.
Which is rare for you.
No, I actually agree with a lot of stuff that Dave Ramsey says. He's got some really good fundamental advice that people should follow. But this one caller, this lady called in to say that she and her husband were in the process of canceling their whole life insurance policies.
Wow. And the reason was?
Well, because Dave Ramsey says that whole life insurance is a terrible asset. He has a flat out, a huge bias against whole life insurance. And these folks had listened to Dave Ramsey and they said, we're going to cancel these policies, Dave, because you said so. And she had a question. Okay. Now, I want you to listen carefully to this. She tells Dave Ramsey that she and her husband have had these policies since 1989.
Whoa. Okay.
Okay. 1989. This phone call, of course, had come in 2015. And she was concerned whether or not there might be any tax ramifications to canceling the policies.
And what did Dave Ramsey tell them?
Dave Ramsey skipped right over the most important thing, but we'll come back to that. And he says, well, these are such terrible investments, the chances are pretty unlikely that you have any taxable gains. And essentially just supported her through her decision and let her go and said, have a great day. Next caller.
But the rules have changed since 1989, have they not?
Oh, yes. So for those of you who don't know this, what Marc is referring to is before 1997, this type of life insurance that she is referring to had some tax advantages that were somewhat restricted after 1997. So any whole life insurance before 1997 still had these amazing tax advantages in full effect.
But she also now lost a financial power in the distribution phase of her life.
Oh, my gosh.
Over and above the fact. Now, by the way, I agree with Dave Ramsey that whole life is a terrible investment. If we're using it as
Yes, not even an investment.
investment.
Wait a minute. Investments have risk.
That's right.
Investments have risk. Nobody loses money on whole life insurance because it's a guaranteed asset. It is not an investment.
Well, the great thing about whole life is that tomorrow your whole life policy will go up. And oh, by the way, the next day it will go up. And
right. And during the next recession, it will go up. And in a depression, they go up. And in a financial economy that crashes in 2008, they go up. They're not an investment. Investments have risk.
That's right.
Right?
That's
so
right.
he tells this woman, basically supports this nice lady who calls in and supports her decision to cancel what might be the single greatest financial tool they have in their portfolio.
Well, and not understanding her entire situation,
Oh,
and
my
I don't know
gosh.
her entire situation, so I don't want to completely judge, but not understanding everything that she's doing and doing a full fact finder and understanding her financial situation to be able to make sense of what it is that she's trying to accomplish. But just a flippant response of just cancel it and get your money back is just poor advice.
No,
period.
That was the part that really, I guess, got me, is that I have made recommendations. Okay, so it's important to know everybody has a bias in one way or another.
Yeah, but you can't have bias toward an asset class just universally.
Right.
I mean, that is financial suicide. You can't just make a blanket statement because you have a bias toward a particular asset class, and then make a recommendation. Hey, I don't like that asset class, so get out, without understanding the full breadth of. I mean, that's like a surgeon saying, you know what, you need to have a knee surgery, but I don't like knee surgeries, so I'm going to do surgery on your shoulder.
Right.
Because I have a bias toward knees, I'm going to do shoulder
Exactly.
surgery.
Yeah, that's so right. And in her case, that bias could severely cost her and her family some financial benefits that just aren't going to be there. I think you actually had a meeting with a client just recently, Marc, that you were sharing a story that kind of fits into that.
It does fit somewhat into that. What we discovered in meeting with this client was that that first of all, they started early, which was great. So some of you may be wherever you're at, you need to start. But the idea that they would have to take enormous amounts of risk was eliminated because they are implementing the strategies that we are talking about today. They're in their middle 30s. They only need a 5 to 6% rate of return in their 401k to be able to accomplish their income goals when they retire.
Okay.
So they don't need to take a whole bunch of risk.
Oh, they don't need 8%.
8, 10, 12, they don't need that. If they get 8, 10, or 12, by the way, it's just a windfall. It's just going to make it better.
Great.
And the amount that they need to allocate towards their future goals is much less. And so, of course, that makes all the sense in the world. I get that. But they are allocating their resources today. And the great thing about it is that they're actually going to end up way ahead of where they thought they were going to end up by doing it correctly today. It was an enlightening experience for them.
But now doing it correctly today means that they're going to bring together actuarial assets and investment assets. So they're going to bring together the stock market world, the annuity world, the life insurance world. They're going to bring together all of those in a plan instead of having a bias against one piece of that puzzle. They're going to have it all together.
That's exactly right. In fact, our initial suggestion was that they allocate just a little bit differently, but they fell in love with the idea that they said, no, what we want to do is we like this so much that we want to continue doing what we're doing, and we want to add on top of what we're doing. And when they did that, they had about a $25,000 increase in their retirement income.
Wow.
So they were already getting a $20,000 increase. And then when they decided to add just a little bit more, their income jumped another $25,000. So a $45,000 increase in their retirement income by adding just a few $100s.
That is
to their
something.
plan.
That is something to
It's
shoot
powerful.
for. That is something to shoot for. When you can move the needle, when you can see the end of the road towards retirement, and you can actually see that you can make that number a reality. That's motivational.
With conservative returns on the climb up the mountain. They don't have to take a bunch of risk.
Okay. I love that. No, that's great. But you said something about these folks that actually ties in. I had mentioned earlier, I was going to promise I'd come back to it, that Dave Ramsey has some solid fundamental advice for people. Really solid. When he gets into areas that certified financial planners and financial advisors like Marc and I should be dealing with, that he really shouldn't be dealing with, sometimes the snippets of advice are so damaging that it just makes our head turn.
It's because he has a bias.
He has a huge bias. But Marc just said something about these folks that he was meeting with, that they are really starting at a younger point in life. They are starting in their 30s, right?
That's right, middle 30s.
Okay. And Dave Ramsey said something on this podcast that I think goes with this. You need to get...
He said more than just what you've told me already?
He did. He said this, because this is the point that I'm getting at, is that you need to take action. You need to move. You need to do it. And he said this. He said, if Eeyore is your spirit animal, then you're in trouble. Okay,
I like that. That one makes sense.
That's so true. Eeyore should not be your spirit animal. Get your butt off the couch. Get over there to the podcast. Download the next episode. Go to our website. Get in touch with us. Take action, because the sooner you do, the better the outcome will be. It's exponentially better.
You can make it.
Absolutely. Well, let's do this. Let's move on to the kind of the final two pieces we wanted to cover. This was actually really big news that gets little or no press from anything in the mainstream, and most financial entertainers are not talking about it. Is this article that we read by Ed Slott. This was actually in Financial Planning Magazine. This is the financial magazine that CFPs and such receive. And it's actually titled Rest in Peace, Stretch IRAs. Okay, so rest in peace, stretch IRAs. Now, maybe we should ask a gift so we don't get without forgetting it. What is a stretch IRA, Marc?
Well, that's an IRA that, for example, I have one when my father passed away, and my mother was had already passed away. That IRA passed to me as an inherited IRA, and I'm able to take that IRA and now stretch its income potential and that IRA over my lifetime.
And you have to pay taxes on it a little bit every year.
That's right. As I have to take distributions on an annual basis, but I'm able to take those distributions over my lifetime, and I am taxed on it, but I can stretch it out over my entire lifetime if I desire.
For a long, long time. Well, that goes right into what Ed Slott said here in his article. And if those of you don't know who Ed Slott is, he is a certified public accountant out of New York. Ed Slott is probably the most famous CPA in the country, if not the world, because he's come out with a number of books, The Retirement Savings Time Bomb, and various other books, and you've probably seen him on public TV. But he's a CPA at his core. He's not a financial practitioner. He doesn't sell financial products. He doesn't work on Wall Street. He doesn't sell life insurance. He doesn't sell annuities. He's a CPA. Okay, that is extremely focused on the retirement income aspects of his practice. And what he writes about here is the death of the stretch IRA option. Because what Marc just described is a pretty fantastic tool that when someone leaves behind a retirement account, that beneficiary can now stretch out the tax savings for another 20, 30 years.
Well, tax deferral.
It's a deferral. You're right. Yeah, don't say tax savings because you're never going to save it. Someone's going to get the taxes someday.
Well, based on just the last proposals from President Obama, I mean, what we talked about with the 401k and his desire to cap
put a limit on how much you can save. Can have.
Now the elimination of being able to take that asset and pass it on to our heirs. It sounds like they're tax hunting. They
are going after taxes. That is exactly. I can't deny that at all. Because what they're talking about here, folks, is they want to eliminate the stretch IRA provision, and they want to cut it down to a 5-year limit that says if you inherit a retirement account from mom or dad or someone, that you no longer can stretch that out over your lifetime. You have to take all the money out in 5 years. That sounds like a tax grab.
Pretty much.
Right.
I love what Ed says here, though, where where the government thinks, "Woo, wow, we've found some money."
Right. The government predicts changing it to 5 years, that they will have a windfall with billions of new revenue from the elimination of this stretch IRA provision. But there's a downside to that, right?
There is. That, in fact, he is predicting that they may actually be a loser in the long run.
Right. So think about this. If you've got some fairly smart, not as smart as Robert Shiller, but some fairly smart financial advisors here on this podcast, and we hear that President Obama proposes that we're going to get rid of the stretch IRA, we're probably going to put our heads together to look for other places to put those retirement assets so that people can transfer them into the future in the most tax-advantaged way possible, right?
Well, again, part of the strategy that we have been talking about, again, about allocating your resources correctly, would fix this problem for not only a spousal beneficiary, but future beneficiaries, your heirs, your children, or whomever it is that you want this asset to go to. Again, properly aligned, strategic assets will eliminate this problem.
Right. Now, Ed Slott goes on to say this as he was talking about the government thinks it's going to be a windfall, but I would agree with Ed Slott that I think the government's going to shoot themselves in the foot, because if you think about it, Ed Slott says, why would a 70-year-old, for example, pay the taxes? Let's say they wanted to convert to a Roth IRA so that they can send this off to a grandchild in the future. Why would they want to pay all of the taxes today to convert it to a Roth IRA only to find out that the beneficiary has 5 years to cash out the Roth?
Not going to want to do that.
No, they won't want to do that. So they're going to want something else. They're going to want an alternative to that. And Ed Slott goes on to say this: turning IRAs, hold on to your hats, everybody. A CPA is about to say something that might make you swerve your car or fall off the treadmill. Turning IRAs into tax-free life insurance policies would bring in short-term cash for the IRS up front from the IRA withdrawals, but could cost the government a fortune in long-term tax revenue lost to good, listen to this, good tax planning. This is from the mouth of a CPA. I kind of want to read it again because I just love the way he puts it all together. Turning IRAs into tax-free life insurance policies would bring in short-term cash upfront on upfront IRA withdrawals, but could cost the government a fortune in long-term tax revenue lost to good tax planning.
Well, because life insurance has some major advantages over the stretch IRA for clients, not only for the client, but for the beneficiaries themselves. Is that not correct?
Absolutely. Slott actually agrees with your comment, Mark. He said that the beneficiaries will be the huge winners. Okay? Huge winners in this, because it's actually now, okay, the government wants to change the rules. You have to remember, you do not have to play by the rules. You don't have to play by those particular rules. There's an entire book full of rules that you can flip the page over, and there's the life insurance page.
You do if you don't plan.
Yeah, you're right.
You do if you don't plan. So if you plan now, you'll be able to avoid these rules. But first and foremost, the life insurance part of this works because distributions to beneficiaries are what?
Tax-free.
They're tax-free. Are they subject to the RMD rules?
No RMDs. That's a huge thing. Those of you who might look at your IRA, 401k, I'll have to tell you right now how many times I've had this conversation, I forget, with clients. One of the biggest, most pain-in-the-butt things they have in their retirement is the required minimum distribution. It is a program put in place that is positioned to force you to liquidate your retirement assets.
Is the life insurance distribution more trust friendly
Absolutely. So when you think about it from distributing it into a family trust, for example, maybe you want to set up plans for grandchildren, for great-grandchildren.
So you can limit the distributions. It's not required.
Exactly.
You can limit how the money goes out. So you can control it after you've passed away.
Absolutely. That's the key. Where the government controls the rules on the IRA, you control the rules on the life insurance.
So in the IRA, I've eliminated the primary beneficiary now, Uncle Sam, and my family is finally the primary beneficiary of all my hard work.
That is such an outstanding point to remember. In your 401k, in your IRA, ask yourself, who is the primary beneficiary of your IRA? And everybody I've asked that question to says, my wife, my children, my husband, whatever it might be. And that's wrong. The primary beneficiary is the beneficiary that gets paid first. And it's always the government.
Our good uncle.
So Marc's point that by using, in Ed Slott's opinion, by using life insurance, you eliminate the primary beneficiary.
You're going to have the IRA. That's not what we're talking about here. We're not eliminating the IRA, the 401k as the growth mode and the opportunity to take income. What we're saying is that you incorporate the second power, the second financial power, life insurance, in concert with the IRA, and then together for beneficiaries and for yourself. First, you're going to have a higher income. Second, your beneficiaries are going to be able to use this tool in a way that they never imagined possible, and eliminate all those taxes and restrictions.
Right. Well, that's
post your death.
That was very interesting. Again, we'll have links to this article from Ed Slott, and well, that's fantastic information. And again, links will be in the show notes. Let's go on to the last section here, the learners will inherit the earth section. We covered annuities in the past podcast as just a general overview. And with the article we just read from Ed Slott, good idea just to cover a very general overview of life insurance. Right?
I agree.
Because it's not all created equal.
Well, because there's so many types, and understanding, by the way, there is no golden nugget of hey, this is the exact right piece. I mean, we do have some ideas.
That's such an important piece. Life insurance, there is a number of different types of life insurance, and no one life insurance is the worst thing ever or the best thing ever. They each have their purpose.
That's correct.
Okay, so let's just start with the one that most people know about, term insurance. Term insurance, if you think about a term of years, you can generally get life insurance that the premium, the amount of money that you pay for it, is set for a particular term, 10, 15, 20, 30 years.
That's correct.
Right? If somebody dies, the life insurance pays out. If you don't die, there's no cash value. There's no value there. You're just kind of renting insurance.
That's right. You have to die within the time frame that you set out. If in that 10-year, 15-year, 20-year, 30-year period, you can't die in year 31 if you had a 30-year.
Right. So it's a term. It's generally something that younger families, your growing families, you have certain obligations you want to protect. Okay, so term insurance, we know what that is. The next kind that we have on the list is
universal life.
Okay, so what's universal life?
Well, there are two types. There's fixed universal life, and then there's variable universal life.
Right. So fixed has just a set interest rate. It does have a cash value component. It does have what people would suggest as a savings component, where you earn an interest rate inside the policy.
That's right. It has a declared interest rate, and so it has a current. So it can be declared as whatever it is today, and then it would have a minimum guarantee. So it can fluctuate between
highs and lows. It can go up and down as far as interest rates.
That's correct.
But it can't go to the guarantees, and generally won't go above where it started.
That's right. Then it has a variable mortality feature, which means that the costs of mortality increase as you get older.
So that mortality, we call that mortality risk or mortality expense, that as you get older, there's an internal fee on universal life that does continue to rise as you get older.
That's correct.
Okay. The next type of universal life is variable universal life. So the word variable, you should associate that with investment or associate that with risk. Anything that is variable in nature has risk. So variable life insurance, instead of just a fixed type of an interest rate condition, variable life insurance will have stock market type investments inside the life insurance that are variable in nature.
That's correct.
Okay, so it goes up and down as the market goes up and down. It has mortality expenses that we just talked about that go up every year. It also has policy administration fees and various different, there's a number of different fees that go with variable universal life that are important to know about, but we won't get into it here in this podcast episode. There's also a certain very important minimum guarantees as it relates to the death benefit that variable universal life has some pretty powerful features as it relates to as investments rise inside these accounts, the insurance companies will often build in a guarantee that says no matter what, if somebody dies, the policy levels that were reached at those high points will always be the benefit received.
That's right.
Right? So that's a pretty powerful feature of variable universal life. Now, the next type, again, keeping it simple today, is whole life insurance. Whole life insurance is the oldest type of life insurance that exists. It is a fixed asset. This is the kind of insurance that banks own. We've talked about it in the past. So that banks own whole life insurance, and some of the differences with whole life insurance is that the mortality costs and the various costs are all fixed. They don't change.
Right. The premium's guaranteed. The cash value is guaranteed. And obviously, once a dividend is paid, it's also guaranteed.
Excellent point. So, depending on the whole life insurance companies, they pay dividends based on profits of the company plus certain guaranteed interest rates.
So that is a big difference between universal life and whole life. That those premiums in whole life are guaranteed. In universal life, they are not guaranteed. You could, if not funded correctly, run into trouble in later years.
With a universal life.
That's correct.
Right. So the whole life insurance, the reason that banks will own whole life insurance is because it is a fixed asset. They don't own universal life because the whole life insurance is a fixed asset, built-in guarantees, and each one of these types of life insurance has their own specific applications, if you will, how you would use them in a financial planning situation.
That's right. If you meet with an advisor that has a bias toward any of these, then that creates a problem because all the tools have been created to solve certain problems. And so based on your own personal situation and what it is that you're personally dealing with, then a tool should be used to solve a particular problem.
Right. We don't have a bias towards any one particular type of life insurance. We just wanted you to know that there's a general idea around each one of these.
That's right.
Okay. Now, I think that's a great place to end. It kind of went really well with, Ed Slott is talking about life insurance as one of those tools that might come in to help people adjust as the IRS and Congress come after changes. And like you said, they're hunting for taxes. This is a way that you can actually include some planning to, as Ed Slott said, basically leave the money to your beneficiaries instead of the government as your beneficiary.
It's kind of like putting camouflage on your IRA.
Putting camouflage on your IRA. Metaphor alert right there. We had to end with an awesome metaphor from Marc.
We hadn't had one today, so
no, that's fantastic.
Now is the time.
Well, listen, we're going to wrap up today with this reminder. We teach classes on this in a very detailed way. And if you're interested in getting more information specifically about your situation, we have this available where you can contact us and we'll do one-on-one presentations where we'll go through much more detail and we'll ask you all the questions needed to actually zero in on your specific situation. You can reach us at personalpensionformulation.com. You can get us over there. That's the fastest way. info@personalpensionformulation.com is our email address, info@personalpensionformulation.com. And don't miss that. So head on over there, get that. Thanks again for listening. Marc, thanks for being here. Awesome. We'll talk to you soon.
Thank you for listening to the Personal Pension Radio Podcast. If you missed anything during the show, that's okay. We took the notes for you. Check the show notes for links, offers, and a full transcript. And don't forget to head over to personalpensionradio.com and download your free retirement income report. While you're there, we'd appreciate some iTunes love. Please leave us a fantastic rating on iTunes by going to personalpensionradio.com/iTunes. Thanks again for listening.